There's a secret sauce top traders use to level up their options trading, and most retail traders have never even heard of it. In this video, we'll break it down and show you how to apply it with 3 powerful strategies you can start using right away. I'm Mike Bellafiore, co-founder of SME Capital, one of the top proprietary trading firms in New York City since 2005, and now in Miami. We've developed and backed some of the best options traders in the game. Stick around. This one idea might completely change the way you trade options.
Hi, I'm Seth Freudberg, and I'm the head trader of SMB Capital's options trading desk here in Manhattan. And as every active trader and investor has noticed, since President Trump announced the extent to which he initially intended to impose tariffs on foreign goods, which were far higher than most market participants had expected, the market has become extremely volatile, careening back and forth between huge sell-offs and in some cases equally huge rallies in this highly news-driven market. And that reality is most dramatically illustrated by looking at the chart of the VIX, the CBOE Market Volatility Index, which basically measures how much options premiums are being pumped up by fear. And as you can see, the VIX was basically living in that 15 to 20 range for the first 2 months of the year. And then as tariff fears began to rise, the VIX began to push higher, ultimately exploding after the tariff announcement on April 2nd, and the index has been unusually elevated ever since. And so when this happens, that spike in the VIX, professional options traders are afforded a huge opportunity that might not be obvious to most market participants, but is very easy for experienced options traders to notice. And that's what we're going to be covering in today's video. So if that sounds interesting to you, then I'd suggest you stick around because I think you're going to find this eye-opening. Now, before we get into the strategies that we're going to be covering in today's video, if you're absolutely brand new to options trading and you don't know much about how options work, we put together a video for you to understand options basics. And if you click the video appearing on your screen right now, it will lay the groundwork for you to understand the option strategies that we're going to be sharing with you in this video. Then when you're finished, you can come back and watch the rest of this video. Let's focus on April 21st, which was another volatile day where, after the Easter 3-day weekend, renewed fears of a heightened trade war resurfaced. And in a volatile day of trading, the SPX index, whose options drive the VIX index calculation, closed at 5158.20, down 124 points on the day. And in turn, the VIX closed up that day at 3382, which was actually a 14% increase over its Friday close. A very large bump in the VIX. And with that as the backdrop, let's take a look at Amazon stock on that same day. And as you can see, Amazon, after rallying like crazy from 145 in early January of 2024, has been selling off with the rest of the market since early February of this year, closing at 167.32 on April 21st. And so let's say that on that day, you had decided that you'd be more than happy to own Amazon at its multi-year low down at 145. And so suppose that you pulled up an options chain for Amazon, expiring a little less than a year later on March 20th, 2026, 333 days later, so about a year later, you went ahead and sold an Amazon 145 put, located exactly at its multi-year low at a price of $11.98. And selling a single put at a strike price where you're happy to own the shares if the stock expires below that put option strike price is known as a cash secured put trade. And it's utilized by some of the greatest traders in the world, including Warren Buffett himself, by the way. And so when you do that, you're actually going to be collecting $1,198 because remember, each put option you sell represents the obligation to buy 100 shares of Amazon at 145. And so you have to multiply that price by 100, which results in $11.98 of cash flow that comes right into your account. And incidentally, you keep that cash forever. That's basically the market paying you for bidding on Amazon stock at a price of $145 per share. And so you get to keep that forever, regardless of whether you're actually required to buy the shares or not. And there are lots of options traders who are happy to sell cash secured puts and never actually take possession of the stock because they're simply trying to collect that cash. Since you'll need to come up with 14.5 if the stock does indeed close below 145 on the day it expires, you need to have that cash available to you should that take place. And so if you think about it, you are basically tying up that capital for, in this case, a year. And so if you think about it, this trade basically has a yield of 8.26%. In other words, the market is paying you 8.26% for you to bid on Amazon at its multi-year low, which is pretty sweet if you think about it, because if that never happens, you still get to keep that cash. But if you do have to buy the shares, you still keep the cash. But now you own Amazon at its multi-year lows, which has proven historically to be a really good place to be on a stock as great as Amazon. And so now we've seen what that trade looks like in a high volatility time like we're in right now, where the VIX is in the 30 range. But how would the same trade have set up in a low volatility time? Well, let's move back in time to February 20th of last year, 2024, where Amazon was trading at almost exactly the same price, 167.08. But this time, instead of the VIX being over 30 like it is these days, the VIX was trading at a more normal level, closing at 15.42 that day, half of where it is today. So let's move out again about a year, 332 days into the future, to be exact, with Amazon trading around 167. So exactly apples for apples with the previous example, but this time let's look at the pricing on that 145 put. And as you can see, it's trading for quite a bit less, 808 in this case. And so even though everything else was the same, the price of Amazon, the distance from expiration, and the strike price itself, the trade only brings in $808 and therefore only yields 5.57%, which means that the high volatility premium, holding every other factor the same, comes out at 48.2% better. And this doesn't just hold for cash secured puts. I mean, let's take a look at, for example, at a kind of a cousin to the cash secured put, a trade that's structured so that if a stock really starts tubing, there's a stop on the trade. And that trade is known as a put credit spread, which is simply where you sell a put just like you did before, but you also buy protection for that put in the form of buying a long put located below where the short put is. And so, for example, on that same day, April 21st of this year, where, remember, the VIX is unusually high, if we go ahead and sell that same put, the 145 for 11.98, but this time we simultaneously buy the 120 put, 25 points lower, which is selling for 575. In that case, then, since we had to pay for that protective put at 120, the cash flow in this trade drops to 623. However, and this is crucial, you will only need $1,877 this time to make this trade because your broker knows you've got that protection, that stop. And so the trade loss cannot get serious, and therefore the way that margin is calculated, this trade will only require $1,877 in capital. And so what that means is that as long as Amazon closes at or above 145 on the day this trade expires, the return on this trade will be 33.1% because both put options would expire worthless in that case. Now let's move back to that February 20th, 2024 date, the lower volatility date that we showed you in that previous example. And if we do the exact same thing in this lower volatility environment, selling the 145 put, which remember was selling for 808 at that same 145 strike, which is also located at that same 22 points below where Amazon's trading at 167, but in this much lower volatility environment. And again, buying 25 points lower, the 120 put, but which in this case costs $315, we can see that we collect much less net premium, $493. And on top of that, by virtue of the fact that we collected less net premium, the trade also will require more capital, in this case, $2,007, because the protection is the same distance away from the short put, but our buffer from loss is less because we collected less premium in the first place. And so when we calculate out the potential profit of this trade, if Amazon closes at or above 145 on the day the trade expires and both options expire worthless, which is the best case scenario, the most we can make is a return of 23.7%. And so the return potential of the trade in a high volatility environment is 39.6% higher for the exact same trade, with literally the only difference being that it is made in a high vol environment while the other is made in a low vol environment. Okay, so in those first two cases, you were better off if Amazon rose and you got to simply pocket the initial cash that you collected. But what if you were neutral on Amazon's price? And what if you thought that over the next year, Amazon was likely to just kind of channel in a range around its current price? That actually happens with lots of stocks where the market doesn't really have a pessimistic nor particularly optimistic outlook on that stock. Well, in that case, if you were neutral, you could put on what options traders call an iron condor surrounding the current price of the stock. And so sticking with that distance of about 22 points from where Amazon is trading, let's suppose that you were to put on an iron condor, where you're staying with that same put credit spread, selling the 145 put and buying the 120 put, but this time you also head up to the call side and sell the 190 call and buy the 215 call, forming on that side what is known as a call credit spread, which you'll notice has the same distance between the short option and the long option, 25 points. And so when you sell a put credit spread where the puts are below the market and a call credit spread, which is equidistant from the market price of the stock, but it's above the market, then you are said to be executing an iron condor trade, which is centered at the market price of the stock itself. Now, the cash flow of an iron condor has four pieces to it, obviously. And so let's take a look at it. And as you can see, the put side's the same, selling the 145 put for $11.98, buying the 120 for $5.75. But now we're adding to it the call side, where we're selling the 190 calls for $16.82 and buying the 215 call for $9.20, resulting in a netted down total positive cash flow of $13.85 when you execute this trade, and a capital requirement by your broker of $1,115. And so if the stock closes in a year at any price between 145 and 90, then all four options will expire with no value, because a call is only activated if the stock closes above the call strike price. And so at 190 or below, both calls would expire worthless. And on the other hand, puts are worthless if the stock closes above the put strike price on the day the trade expires, because puts are only activated if the stock closes below the put strike price. And so therefore, if the stock closes between all of the options, between 145 and 190, then the trader just gets to keep the cash flow he first collected, that $1,385, which is the maximum gain on the trade. And so the best case scenario return on the trade would provide you with a return of 124.2% against that required capital of $1,015. But if we go back to February of 2024 and do that same trade, but in that much lower vol environment again, you'll see that all the options are lower priced, as has been consistent through all three examples. And so you collect less premium when you net it all down, collecting only $1,158 in premium. And by virtue of collecting less premium, your capital requirement is actually going to be larger, resulting in a much smaller potential return on the trade of 86.9% compared to the high volatility iron condor, meaning that again, the high volatility iron condor yields a far better return potential, 42.9% better than the low volatility trade. And so what I'd like you to take away from today's video is that when high volatility hits the market, it creates a supercharging kind of an effect on the potential of options trades in many cases, as these three examples demonstrate. Professional options traders are well aware of this extra edge in premium selling strategies like cash secured puts, put credit spreads, and iron condors, and they take full advantage of them when the opportunity presents itself.
Now, if you'd like to learn 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, and the options income strategy that allows you to make consistent money whether the market goes up or down or sideways, and how to make money on a stock or index trade even if you're wrong on the direction, then click the link that's appearing right now at the top right-hand corner of your screen. That will open up the free workshop registration page in a new window, so don't worry, you won't lose this video. Or you can register directly for free at optionsclass.com.